In just the last few years, we have seen US regulators hone their focus on the crypto industry's regulations. This enforcement, unfortunately, is being felt not just within the country, but worldwide. At the forefront of this enforcement is none other than the Securities and Exchange Commission, better known as the SEC. When former investment banker Gary Gensler became chairman in 2021, the agency started clamping down on the industry relentlessly. Gensler testified before the House Financial Services Committee on the 18th of April that crypto marketplaces were rife with non-compliance. He also said this endangered investors, eroding confidence in the capital markets. By that time, the agency had already been embroiled in a lawsuit against Ripple, a US-based firm that operates a currency exchange and remittance network on the blockchain. The SEC had accused Ripple of breaching US securities law by offering their XRP token without the approval of the regulator. Now, the nature of the lawsuit is extremely significant because of how it can influence the way the SEC sees other tokens or cryptocurrencies. Take Ethereum, for example. The SEC had clearly established time and again that it should be considered a security. The Ripple lawsuit, however, is not the only case the SEC has opened against other crypto firms. Coinbase, the largest cryptocurrency exchange in the US by trading volume, was served a Wells notice, which simply put means the SEC had identified potential violations of US securities law. In response to that, Coinbase described the SEC as unfair and said the Wells notice had little information about its potential violations. Ethereum-based DEX, SushiSwap, had also received a subpoena from the SEC, while Kraken, another exchange, was charged for failing to register the crypto staking asset program. That's not all. CoinMe and Up Global paid a total of $3.77 million for conducting an unregistered offering of a crypto asset called Up Token, even though they never admitted any wrongdoing. Bittrex, another exchange that faced an SEC charge, exited the US after 9 years of operations there and declared bankruptcy soon after. Market-making firms Jump Crypto and Jane Street Group are also withdrawing from trading digital assets in the US, citing regulatory uncertainty. So, what does this mean for the broader crypto landscape? Well, with the stringent and confusing regulations in the US, global investors are becoming increasingly concerned and are reluctant to enter the market. And no surprises for guessing, but US crypto firms are starting to look overseas for their endeavors. For starters, American cryptocurrency exchange and custodian Gemini has announced a new non-US crypto derivative trading platform called Gemini Foundation. They've been clear that the new offshore exchange will not onboard US customers. Even Coinbase CEO Brian Armstrong has expressed that relocation is on the cards, with the UK, the UAE, and Bermuda as possible alternatives. Circle's USDC has also lost its footing against their rival USDT, citing investors' need to de-risk out of the US as being a critical factor in the stablecoin's fall. In fact, they launched a new office in Singapore recently. This tightening grip on crypto firms in the US naturally opens up opportunities in other regions of the world. We are beginning to see companies exploring greener pastures in countries like Australia, Dubai, UK, and Hong Kong, simply because of the better regulatory framework, tax benefits, and friendlier government. According to Hong Kong's statement, over 80 virtual asset-related companies have expressed interest in establishing their presence in the country. Even now, the SEC is still under fire for its inability to give clear guidance, as seen during the oversight of the Securities and Exchange Commission hearing featuring Chair Gensler. These roadblocks will likely cause a slowdown in the growth of the entire crypto industry. Despite being at the forefront of crypto from the very start, the US's overzealous crackdown, if continued, will see the industry shift towards more favorable markets and countries. The SEC still has an opportunity to clarify its stance, but it's safe to say the damage has already been done. Ball's in your court, Gensler.